perspective, at least, I think a lot depends on, how the Federal Reserve is able to actually navigate the inflation back to their comfort zone, whether it's a hard or a soft landing. That will really depend on if it's, I would say, if it's a soft landing, they will have higher interest rates for longer. If it's a hard landing and there's a significant recession, they may reduce interest rates again to start growth again. But in general, what I would say is that if we have got high interest rates for some time now, and as we know, higher long-term interest rates are generally lead to kind of higher cap rates. So I think we can expect higher cap rates, if expectations for long-term interest rates remain. There is kind of some uncertainty there. The 5-year swaps are higher than the 10 years at this moment. So there's a partially inverted yield curve, which kind of points to some moderation in the longer term interest rates. But in any case, I think if in the higher interest rate environment, and assuming, you have some cap rate increase over there, I think it'll affect, differently across different property types. I think multifamily will probably be the least impacted, mainly due to the short-term nature of leases. Rents will increase with inflation, hopefully, and they'll be rapidly recalibrated. We're kind of currently already seeing that. We're seeing higher rents everywhere across the board in multifamily. Of course, the more recent data shows rental rate increase is decreasing, but I think it'll still remain positive unless there's a very, very significant recession. The other, kind of headwind on that front is lower affordability for single-family homes with higher interest rates for people. So people are kind of moving to rent rather than buy, since many people can't afford it. I think so I think multifamily will probably be the least impacted in terms of pricing. I think industrial and self-storage will also be less impacted. There's strong demand for that. Again, some of them have short average lease terms, so they should be recalibrated quickly. Hospitality may be impacted if there's a deeper recession, but I think the leisure hospitality market is doing pretty well right now. So I think there's some comfortable cushion there. Office, of course, is a very different story. The long-term nature of leases coupled with the uncertainty regarding demand for office space going forward due to companies' work from home policies and what kind of the new normal would be, makes it a really, really challenging space to be in today. I think there will be significant repricing on office space, especially in the Class B, C. I think there's probably going to be conversion of office space into other uses, especially in large cities like New York City and San Francisco, LA, where there's a lot of available vacancy now and much higher than the Class B, C space. In terms of retail, I think grocery anchored retail may also be less impacted, but high street retail may be more impacted if there's deeper recession. But let's be honest, retail's already kind of taken even pre-COVID, there's been a significant correction. I would just say, one tailwind that we have is because of high construction costs and the supply chain disruption, is there's just been, much less supply that's come underway. So that should help, and it could, if things suddenly growth returns really fast, you could have a pretty significant repricing in rents and increase in rents, etc. in that situation. We haven't again seen that happen as yet. The repricing hasn't happened as yet, but I think we witnessed people are more in a wait and watch environment here. Investment sales have dropped by more than half across. Some of the largest brokers have mentioned this year that they haven't done almost any office transactions. So, I think people are just kind of waiting and buyers and sellers just holding out till more clarity on long-term inflation expectations and interest rates.